Hey there, everyone. Dave Keller here with Market Misbehavior, and welcome to our latest episode of the Market Misbehavior podcast. Our goal with this podcast is to sit down with top market practitioners, traders, money managers, authors, educators, strategists, pick their brains a bit, see what they're seeing, what they're hearing, get a sense of how they approach the markets and what their tools and techniques are telling them about the current market environment. Today, a repeat guest on the Market Misbehavior podcast, Jeff Huge. Jeff is the founder of JWH Investments based in the Minneapolis area. He's also the author of two very successful newsletters, Alpha Insights for institutional investors and Huge Insights, love that name, Jeff, for retail investors. Jeff and I have talked a number of times. We last spoke at the end of April. Since that discussion, the market has obviously had an incredible rally. Valuations have increased. As he will point out, leverage and positioning and sentiment has certainly increased as well. And now the question is, what's next? The market's showing some signs of weakness, and Jeff was ready to share some perspective on how this could be just the beginning of further deterioration for risk assets. We covered a lot of bases, talked in particular about valuations, looking at CAPE ratios, looking at different ways to really define the overextended market conditions that we're observing here in early August of 2025. But we also talked about some different measures of sentiment in terms of positioning data, in terms of leverage, and the amount of money and amount of capital that investors have been devoting to risk assets, arguably at extremely bullish levels here. We also talked about seasonality. One of my recent episodes with Callum Thomas, we talked about seasonality in the VIX. Jeff revisits that discussion, even shares a chart from Callum's work, and we talk about how that fits into the rest of our discussion. Also, seasonal weakness in August and September, which is 100% true. Given all of that, we talked about deterioration and momentum, deterioration in the breadth, some of the tools and information that Jeff is using to validate the fact that we may be seeing certainly a downside rotation here. And then the question is, what's next? And Jeff is ready with some downside targets on the S&P 500, some short-term targets, also some potentially long-term targets, depending on what sort of deterioration, what sort of corrective move we may see. Great discussion, one that certainly made me think, and I hope it encourages you to think about things as well. Please enjoy this conversation with Jeff Huge of JWH Investments. All right, so we're checking in today with Jeff Huge. Jeff is the author of Huge Insights, and also tell us all what you're doing, Jeff, because as a reminder, you have a retail-focused Substack. I think it's called Huge Insights, but also an institutional platform as well, right?
That's right. Yeah. Alpha Insights is how I started this about 7 years ago. And then, we continue to get all kinds of interest in it. And, there was clearly a retail interest, but not a retail price point. So we launched the Substack, Huge Insights, the big picture, just trying to kind of summarize some of our views over the past 30 days. And that's gone very well.
No, it's awesome. I'm so glad that, and it's great to follow your work, and I appreciate that you're sharing it with the broader community here with through the Huge Insights newsletter. Obviously, you and I spoke last, Jeff, late April. I feel like from late April to now early August, there's been a world of change in so many ways, right? I mean, the market has evolved so aggressively in so many ways. And now we're at this pivotal point, and you and I were speaking before we started. I mean, it's perfect time to just sort of circle back, see what's happened, from that point to where we're at, what's kind of worked, what's surprised us, what's been very expected, but then really looking forward, because we're entering into a period where it sounds like things could become a lot more challenged. Having said that, you have some really good charts that you brought with us that I want to get right to, Jeff. Start us off with just how performance has been. I feel like as much as we're talking about this as like the year of large cap growth, that's pretty far down the list of things that have actually done well in 2025, right?
I concur with that. It seems like that's all they want to talk about in the financial media is AI and the Mag 7. But, in fact, silver and gold have dominated the performance of the capital markets. And as you may recall back in late April when we spoke, I declared our top actionable trade idea of the year was silver, and silver is in fact leading. Up a little bit more today, but gold's hot on its tail, and also in hot pursuit has been Bitcoin. It's fits and starts. It started out strong, fell off the map, came, roaring back and had been, dead even with the precious metals, and has pulled back a little bit here since. And we'll have more to say about crypto as we get into this interview, because it is an area of interest. Let's put it that way.
Yeah. I mean, and I feel like still, and I don't know if you've gotten this sense too, do you feel a resistance to things like silver? I mean, it's performed so well in 2025, but still people don't automatically lead with that as an obvious area of strength. We're still sort of thinking AI over everything, right? Do you get that resistance to the dominance that we've seen in some of the precious metals?
Yeah, it's amazing to me. It just baffling, frankly. I'm vexed by it. It is the best performer by orders of magnitude, threefold. Yet people just
Yeah.
ignore it. And I think even given that performance, it remains the cheapest asset on the planet, in my opinion, based on the valuation work that we do.
It's so interesting because I feel like technical analysis, what you and I practice is basically focusing on the evidence the markets provide back to us. And I feel like this is one of those years where if you focus too much on the narrative, which is the dominance of AI, I mean, granted, you've had a decent year so far, but you've been much better off being in other things that have had much stronger charts. So it's a great reminder, in my opinion, of the strength of charting and sort of the benefits of focusing on where the returns have been. So if we could, I mean, can we look at the smaller? I mean, what about some of these underperformers? I mean, small caps down 4.5% year to date. I feel like the resurgence of small caps, the return of small caps, has been declared numerous times, and it's never really played out.
Quite the
Does that
myth.
happen at some point? Right? I mean, does that happen at some point, or is that just? I mean, how do you think about some of these underperformers that have been kind of chronic down at the lower end of the return table?
Well, and it's not even just small caps, right? It's all
Yeah.
secondary stocks. In fact, the median stock has underperformed T-bills. In fact, up until just yesterday, it was the average stock underperforming T-bills year to date. And so, I would say if we just think about small caps and mid caps within the S&P 1500, that's 1,000 of 1,500 stocks. So 2/3 of the S&P 1500 is underperforming T-bills year to date.
Mm. No,
And in
that's really
fact,
well
Dave,
put.
the S&P 500 appears to be up eight and change, right? But the
Yeah.
average, if we look
Yeah.
at the equal weight S&P 500, it's up four and change. So, has performed half as well as the big cap driven cap weighted index.
Jeff, you shared a version of this chart with us before, and I mean, looking at it with fresh eyes here, it strikes me that for so many individual investors, like their sort of area of focus is kind of the growth column to the right, and they've ignored the stuff to the left, which are
Yeah,
non-U.S. stocks, which have significantly outperforming
yeah.
consistently, year to date, into the April low and out of the April low. Bitcoin, gold, silver, these are the ones that have generated the strongest returns. But
Yeah.
so many of us kind of have the blinders on with large cap growth and sort of the other Morningstar style boxes, right?
Yeah, the U.S. exceptionalism, seems to have just, immersed everyone's attention, right? But it's
Yeah.
been a non-dollar market that's really outperformed. To your point, foreign stocks have been the dominant equity leader year to date, and have outperformed, the S&P 500 by a factor of twofold. So, and it's actually pulled back somewhat from its peak, but still, leading very strongly. And so, we've been advocating an allocation toward foreign stocks with emphasis on emerging markets where we see enormous value and growth.
Yeah. Oh, it's such a beautiful chart. Great way to kick things off here, Jeff. And I appreciate you again bringing that right to the forefront. Talk to us about valuations. I mean, I feel like it's hard. I mean, I'm curious what your take, but in a bull market phase, valuations can get quite elevated, but this all of a sudden feels like we're getting to extreme levels. Put valuations into context for us. Where are we at relative to where we've
Sure.
been in your perspective?
Well, yeah, the Shiller Cape ratio, which is the upper left-hand corner of this grid, at 38.6, is now higher than it was at the 1929 high, all-time high back then before the Great Depression, which was about 32 and a half times. So that's just putting it in perspective. There's only been one other time in history that it's been higher than it is today, and that's at the dot-com bubble peak, where, there were a lot of non-profitable tech stocks that were driving the market back then. Pets.com is the obvious one that people always point to, but there are many, many others that fit the bill that just were unprofitable, but leading the averages. And so, I think if we look at things on a balanced, all things being equal view, it's never been more expensive than it is today. And if we look at things on different metrics, price to sales, for example, price to book, both hit all-time record highs on July 31st, never before recorded in history. Now, I get in a growth market, when growth is scarce, people will pay any price for growth, right? And when the growth stocks are the dominant market cap, top 10 stocks in the S&P 500 now account for 38%, I believe, of the total market cap, it's going to skew things up. But to record levels that are just at unprecedented extremes, to me, and the other obvious one is market cap to GDP. We don't have a graph of it here, but it hit 210, I think even 213% at one point. Now it's 210%. At the dot-com bubble peak, it was 143%. So, we're in uncharted waters when it comes to valuation at this point. And all I know is bad things happen on a forward 1, 3, 5, and 10-year time frame when you start at this level. So, people who just got off the boat today and are putting their first dollar into the equity market, chasing Palantir at 110 times forward earnings, probably have a very low probability of generating a positive absolute return over at least the next 3 to 5 years. And I think longer term, 10 years might even be in question.
I mean, it feels like, Jeff, with all the instability we're recognizing, volatility is starting to increase here going into August. And we're seeing some, maybe signs of weakness randomly, which I know we're going to go through certainly in a little more detail. But then a Palantir comes with earnings this week and just continues to go kind of up and to the right and continues further. So I appreciate this illustration of valuations. But to your point, when I think the way you said it was beautiful. When growth is scarce, people pay anything for that growth, and that's certainly what we're seeing. I'd love for you to talk about the dividend component, because this one of the other sides of the coin, I guess, with growth being so dominant. These are companies that are not big dividend payers, arguably not big earners in a lot of ways, but are getting valued higher and higher. But the income component to your equity story is becoming less and less meaningful as a result. How does that motivate asset allocation decisions, do you think? Do you think that fuels interest in gold and precious metals as a store of value if you're not getting an income component? Does that spur interest in treasury bonds and risk-free assets? What does that mean to you when the dividend yield is so consistently low now?
Well, certainly it's a harbinger for extreme valuation, right? It's the inverse of, if you think about how equities are looked at from a valuation perspective and then put bonds in the same light, that low dividend yield suggests that, the underlying asset itself is very expensive. Now, having said that, if we look back over time, part of your total return dating back the last 100 years, about 40% of it, in fact, has been the dividend component for equities. That has narrowed dramatically over, the last 30 years, right? And so from my perspective, I guess it does, bear some issue as to, first of all, what are the trade-offs? What's the opportunity cost of owning gold versus equities? Since I'm not getting much of a dividend there, it's much, much lower. And I think that's part of what's happening. But there are so many things to consider. The other thing to think about is, like, back in 29, as we were talking about, what was the Palantir of its day? Well, that was RCA. Okay, RCA radio was, the big broadcasting. That was the technology. That was the AI of its day, right there. And that stock peaked at like $114 on a post-split basis and traded all the way down to a couple, maybe $3, which was apparently book value. Now, fast forward to the dot-com bubble. What was the big leader during the dot-com bubble? What was Cisco? Cisco did not pay much of a dividend. Cisco also traded at a very extreme valuation. It was a 39 times sales, 100 times earnings. Same thing as Palantir, right? And what happened to that stock? Well, it peaked at 92 and dropped all the way to $5. What was $5? book value. Okay. Now, I put this art in my last newsletter, not this month, but in the June newsletter, maybe the July newsletter. We talked about the bubble, paradigm, right? And so we looked at Cisco Systems and we said, okay, now Cisco, what's like Cisco today? It's NVIDIA, right? And so NVIDIA is, the must-have stock. It's the it girl, right? And so everyone owns NVIDIA. What's the book value on NVIDIA? Well, it's like $3.12. So, that stock hit $187. Where do you think it's going to bottom when the Christmas tree forms? The other side of that Christmas tree, because it's a parabolic rise. And I'd throw Palantir into the same equation. We already saw one stock do it, SMCI, that super micro computer. Shot up to like 1,500 and then dropped all the way to 32. As soon as accounting fraud came into work. Another stock that stands out is Meta. Okay, you've already got Jim Chanos looking at the cash flow statement, going, you know what? These guys have they're using an 11 to 12 year depreciation when their GPUs are probably going to depreciate over 3 years. They're overstating their earnings by 3 to 4 times. So that's the other one. Meta, the Sydney Sweeney of stocks. I said in my recent newsletter, but I think even the people blinded by greed in this stock are going to realize that they're only kissing a frog. And then I show the picture of Mark Zuckerberg as a contrast.
An aggressive but maybe appropriate comparison, Jeff. I like it. All right, talk to me about positioning here. We're looking at the Commitment of Traders report, the CTA. What is this telling us about positioning relative to these valuations we've been reviewing?
Yeah, well, we're in the 99.8 percentile. Okay, it's an all-time record high as far back as Nomura has tracked the data. And, this was as of a week ago. Maybe it's a little bit more, a little bit less, not that much different though today. All we're saying here is that, we're all-time record extremes in valuation, all-time record extremes in CTA net long positioning. What other things are adding up on this side of the ledger that could, create a problem? Because, when the levee breaks, all of that long exposure is going to shift the other direction, right? It's just the natural consequence.
Yeah, this is fueling that appreciation, but when that dries up, it can go the other way as well, right? We have a couple of charts that I think that tell a pretty interesting story here. Talk to us about leverage as well.
Again, margin debt just hit $1 trillion in June. Now they reported about a month, in arrears, so we're hearing the June number in July.
Yeah.
But this is systematic leverage within the stock market. Maybe a better way to think about it is net credit balance. Okay, so that's what this red mountain chart is, and we've overlaid that with the S&P 500 index, and it hit an all-time record extreme of negative $620 billion. That's about 3 times the leverage that we saw at the height of the GFC or pre-GFC, the real estate bubble, and like 5 times greater than what we saw during the tech bubble. And so, at the end of the day, this net credit balance is, the combination of all positive cash plus positive credit balances in margin accounts, right? And then subtract margin debt from that. And so, basically, that nobody's got any liquidity to stop the bleeding. As I say in my newsletter, the people that love their jobs more than anybody else on Wall Street are margin clerks, right? They are, I kid you not, they are the types of just sellers that can't be repressed, right? They take pride in selling. And it's really because they just want to look out the window and watch you get your Lamborghini repossessed, right? That's what's motivating them. But they're brutal, right? They're brutal sellers. They won't stop. And if you don't have the cash to put up as collateral for that margin call, you will be liquidated, right? And so I think this points to the fact that, again, everybody's on the wrong side of the boat or one side of the boat, right or wrong. And the leverage there is really what could break the model, so to speak.
All right, so we've got leverage, we've got positioning at extremes. Talk to us about speculation. This is looking at the options market, right?
Yeah, S&P call option volume hit $1.2 trillion earlier this year. I mean, that's
Wow.
off the charts. It's unprecedented speculation. It's, 98% on the long side of the market, right? And, here's the thing, okay? The vast majority of money made in the options market are option sellers, the market makers, the guys selling the option, not the speculators going long calls on the S&P. It's the guy selling the call. 90% of the time, those calls expire worthless or are
Mm.
closed out before expiration, typically at a loss. Okay, so what I'm saying here with this is that you've got a lot of people betting on the S&P going higher over the next, 3 to 12 months, right? And the guys that are really going to make the money here are the guys that sold those options, because the chances are they're not going to, it's not going to be a windfall profit for the speculator. And so, we got speculation at record highs, we've got positioning at record highs, we've got leverage at record highs, and we got valuation at record highs. That is a formula for disaster typically.
Boy, this isn't giving me a great feeling, but I mean, 100%. It's hard to disagree with the extreme levels that we've seen. I guess the argument that I guess bulls are making at this particular moment is that none of those charts matter, and that we just continue to push higher, onward and ever upward. Let's talk about some of the signals that we could start to see that would tell us that these extremes are now starting to get alleviated. And let's talk with seasonality, right? Where we've come out of May, June, July, which have been incredibly strong months in recent history. I mean, over long term, but certainly since the COVID low. I mean, May, June, July has been a rock star period.
Yeah.
What about August, September? What happens next?
But seasonality wise, August, September, October are seasonally the worst months of the year. September's
Yeah,
the worst, August is second worst, and October's typically where bottoms are made. But
yeah,
this, happens to be an interesting period because there's a 3-year cycle. You can look back to 2022, 3 years ago. We had a disastrous collapse from August 1st into the October 12th low. It was down 19.3%. Okay. 3 years before that, 2019, we saw another big decline. 3 years before that, 2016, we saw another big decline during the August, September, October period. Now, to add insult to injury, it happens to be the second term of a new president. August tends to be disastrous during the second term of a
right.
president. And then it's also the 4-year presidential cycle. The first year of the presidential cycle has the most significant decline, the most exacerbated decline from August 1st to October 31st. It carries right to that September or that November 1st level. And so I think this is going to be, all the cycles are in synchronicity right now. And so it probably behooves investors after such a big run to hedge, to take some chips off the table, to sit in cash for a while and just enjoy the rest of the summer. Come back and after Labor Day and take another look.
This chart, by the way, it's sourced from Ned Davis Research, who, wide following in the institutional community. They do fantastic deep dives into market history and tendencies. And in blue, we're seeing the 4-year kind of traditional 4-year cycle for 2025. What's sort of the idealized path based on market history? And then in yellow, we have the current year. It's followed very, very well. And sort of in this kind of 4-year cycle, you should expect a pretty decent move from April until August, but then August through October, remarkably weak. Your next chart, by the way, Jeff, I'd love to talk about, because we had Callum Thomas of Top Down Charts on the show just last week, and we talked
Yeah.
about seasonality in the VIX. How does this fit into the chart that we just looked at?
Yeah, Callum's a friend. He does great work, and indeed, I think the study that he's produced really shows definitively that contra to the S&P, the VIX has the exact opposite, cyclical tendency and seasonal tendency here, and so we should expect the VIX to move up from somewhere in the mid-teens to somewhere in the mid-20s, historically. But when accidents happen, Dave, volatility can surge much, much higher. We saw that in April, right? On Liberation Day. And it wouldn't surprise us at all to see something similar occur if, in fact, all of these seasonally synchronized and cyclically synchronized events start to come to a tipping point, right? But the one thing that I'd point out is that vol targeting funds, like the CTA systematic traders, they don't like higher volatility. When volatility goes up, that forces them to sell. It's part of their formula, right? It's not a question of are they going to think about it? This time, maybe they're going to, their gut feel is that they're just going to ride through it. No, they just systematically reduce, and then short if things start to move in the opposite direction. So, I think that positioning extreme could easily move to the opposite extreme over this 3-month period of time if volatility were to accelerate and potentially surge over this seasonally inclined period, right?
Yeah, no, two really good charts there. So speaking to what normally is a seasonally weaker period for stocks, August, September into October, and they, I guess, flipped over the seasonal rise in volatility that we often see in this period. And again, conversation with Callum was awesome, and he made some really good points about this chart as well. So I'm really glad you highlighted that one. So that's what has tended to happen in August and September. Let's talk about some of the signs you've been observing going into where we're at now in early August. Start to talk about momentum, because I feel like people have been, wildly optimistic, all arguably euphoric in terms of positioning, but certainly the trend has been quite positive. What signs do you see that suggest maybe that seasonal pattern may be playing out here very soon?
Yeah, well, we're looking at a daily chart of the S&P 500. Below it is its momentum. It's the divergence above or below its 10-day exponential moving average. Okay, and so that has made steadily lower highs as the index itself has moved up over the past several months to its recent high as of last Thursday, July 31st. And I think, this waning momentum has left a negative divergence evident in the daily. It's also evident in the weekly and the monthly, and we present those in our newsletter. And again, typically it's not inconsequential when all three of these cycles or degrees of trend are waning in momentum at the same time. It tends to suggest that something very important is happening, an important top, an important change in trend. And so, this sort of signal, this negative divergence, typically precedes a significant trend change in the index in price. And so I guess our inference here would be that one should expect a change in trend. And I think we're starting to see that. Last Friday, we saw, kind of a kickoff. We've come back in and filled the gap, yesterday and today, and now we're down again a little bit, I guess, last I looked. And so, this could be the beginning of that trend change. And I think we need to be cognizant of all of the, considerations that we should be making ahead of that seasonally, and then all those positioning structures that we discussed.
No, well said, Jeff. To geek out on the technical analysis side of what you said, there's a brilliant use of the PPO indicators, using it to look at where we're at relative to the 10-day exponential moving average, and that divergence really just speaks to the fact that the pace of the advance is starting to slow, because we're getting closer and closer to that moving average over time. It's a great way of illustrating some of the waning momentum there. I like that a lot. Breadth as well, right? I mean, I think the breadth generally has been positive, and we saw a surge in breadth. But I would tend to observe, certainly over the last couple of weeks, I feel like from mid-July now to early August, there's been a change, and you've seen that as well in your work.
Yeah, we have. And, one of the ways we look at it is the 200-day moving, so the percentage of stocks above their 200-day moving average, which we consider to be the long-term trend. And we don't just look at the S&P 500, but we look at the full market. And the NYSE is a very broad measure, 2,200 stocks. And if we add to that the entire NASDAQ index, you're talking about 5,600 stocks, right? And if we look at that, only about 41% of those stocks traded on U.S. exchanges are above their 200-day moving average, which means, basically 60% for all practical purposes is below, right? And so, that suggests that we're not really seeing this broadening of breadth. We are seeing it within the large cap index to some extent, but even so, the NYSE and the S&P, peaked one day apart, right? The 30th and the 31st.
Yeah.
Yet if you look at the lower panel of this chart, the NYSE advanced decline line, which is looking at cumulative advances minus cumulative declines, right? And that made a lower high. It failed to confirm the higher closing high on the NYSE comp and the S&P 500, as well as a number of other indexes. And, that's one of my old mentors, Alan Shaw, who was a legend on Wall Street, one of the original members and founding members, I believe, of the CMT Association. And so, I worked with Alan back in my Smith Barney Citigroup days for a number of years. And, he would tell me that if he was, trapped alone on a desert island with his favorite bottle of scotch, and he could only have one, indicator to help him monitor the market, well, that would be the AD line. And it's his favorite sell signal. When you see this negative divergence, it is a telltale sign that the market is peaking and ready for a change of trend. The only thing that remains to be seen is whether this is the change of trend or just the beginning of a topping process. And so we'll have to wait and see. But my suspicion is the stars are in alignment for something more important right here.
So I mean, fantastic chart so far, Jeff, and I really appreciate you sort of laying out the case for a rotation here with seasonality, with positioning and sentiment, and momentum and breadth. We're seeing all these signs, but I guess for most investors, right, the question is, we've seen pullbacks, right? We've seen pullbacks just this year. We've seen pullbacks, over the last 10 years. And in the end, right, the challenge is differentiating a brief, kind of very viable pullback from something much more significant. So getting to your chart of the S&P, like what would you need to see that would tell you this isn't just a pullback from overvalue? Because a lot of times things are overvalued, they pull back a little bit and then we kind of reset. What makes this a different look where all of a sudden, oh my gosh, it's time to get defensive?
Well, certainly when we take out the 48.35 level from the April low, it's going to be a little too late to get defensive. You'll have left 1,500 S&P handles on the table, right? So we've got to be a little bit more in front of this. And so we've put out a couple of levels. I think the 61.47 level. I think a solid weekly close below that level would be the initial indication that a meaningful top is in place. And of course, my critics will be the first to tell you that, Jeff, you've been great at calling tops, right? But you're not very good at calling bottoms. You keep saying that this is the big one. And why do I keep saying that? Well, the reason is because we see that we're in this terminal sort of formation, this ending diagonal triangle that we've highlighted there. And I think, from that perspective, if we're right about that, it means that we're at a terminal state within the S&P's advance. And so what would give us a lot of conviction on that would be a close below 5,900, which is the 200-day moving average. That would definitely give us some sense that the market in general is no longer in an uptrend, at least, a longer term. And so, and of course, that could be resolved by another move higher. We put out a target range, months ago, and that range was 64.25 to 65.50. And the reason we came up with that range is we said, well, look, 64.25 is about where we think, this trend would intersect with the upper boundary of that diagonal triangle, right? But if we get a throw over, which is not an uncommon feature within an ending diagonal, it's fairly common thing that could occur. Well, then it could shoot over the top of that upper boundary, and if it did, well, how far would it go? Well, typically a throw over is about a 1% to 2%, but typically about 1% above. Well, that would be about 65.50. So, maybe this pullback's just setting up for that throw over move to 65.50. And that would make Tom Lee and all the other bulls out there on CNBC that are talking about a move to 6,600, new all-time highs. Well, they'll look like heroes, but it doesn't mean that we're wrong. It just means that we're getting the throw over here. And maybe that happens. Maybe it doesn't. Maybe we've already seen the top. And, we tagged that 64.27 high on Thursday. And it wouldn't surprise me if that was the top. And the big surprise to all the bulls out there is that we get a meaningful decline. And this decline, I think, will shake people to their boots, because I think the downside potential is a 61.8% retracement of the entire advance off the 2009 low. And that would carry us all the way down to about 28.67, which would be about a 55% decline to the cycle wave A low. This will be a 3-wave decline, so we'll get a big rally off that level, but the ultimate decline, I think, should be much, much lower than that, possibly down to, say, 1,000 on the S&P 500, which no one can fathom, right? Just like they couldn't fathom 667 on the S&P when it was trading at 1,500, right? It was impossible to conceive of a 67 or 70% decline from its all-time high. Well, these things have happened, right? We've seen the NASDAQ decline by 80% in our lifetime, in our professional careers, right? So this can happen, and to eliminate it from the realm of possibilities is the best way to make sure that you don't have a very secure retirement. You need to consider it.
No, this is super helpful, and what you had mentioned there on the last chart, Jeff, about a throwover, and to be clear, what you're suggesting is, that was a monthly chart of the S&P we're looking at. We could have a brief, push above the upper boundary of that pattern as sort of that last gasp higher before the rotation. And I think Elliott Wave kind of accommodates for that sort of extended move that can have at the end of that move, right? So I guess the most important question then, obviously you've highlighted some signs for concern, the weaker seasonality, what a potential future path looks like. How do you position yourself today, or how do you try to get ahead of that? We're still in an environment where so many leading growth stocks still appear to look good. Like Meta, with all of its issues, is still going higher from a technical perspective. Do you get defensive now, or how do you start to think about, how do you navigate this period positioning wise?
When the selling begins, Dave, it will be merciless. Okay. You will not have a chance to get defensive. You won't be able to believe what's happening. You'll be frozen like a deer in the headlights, right? And so you need to be in front of it. And one of the ways that I think you can be in front of it is to diversify, right? Diversify away from what's working best and start to rotate into some of the laggards like value, emerging markets, where growth exists, right? Value stocks are good, high quality companies in the US that aren't going to go bust. Guess what? Worked really, really well when Cisco Systems was declining. DuPont went to new all-time record highs as the S&P was collapsing, right? So, a deep value stock that no one could make a case for when Cisco was at its all-time high. So you got to be in front of that. I don't see any problem with owning T-bills, even if they cut rates to 3%. You're still getting 3%, right? Own tips. I like tips because real returns right now are 2.5%. That's the best real return we've seen in 25 years in fixed income markets. I also like foreign bonds. I like non-dollar. I like foreign currencies. I've been doing a lot more in foreign currencies lately. Gold, obviously, silver, obviously, are areas that we've been really, really fond of and advocates of in recent years. I also like mining stocks. Mining stocks are incredibly cheap right now. I think the all-in sustaining cost of pulling an ounce of gold out of the ground for the average miner is $1,426. Gold selling for $375 spot and I think $34.25 on the December contract. So these guys are selling into the December contract with 125, 130% margin. That's a pretty good deal. I also like rare earth elements, rare earth metals. We put out a note on REMX, which is the ETF that surrounds that. MP Materials has been a big stock in there, and that's one that the government threw some money behind. I don't think that'll be the last one that they support. And then last but not least, I'll say crypto looks interesting, and we've just done a deep dive on Ethereum. Ether is the crypto that supports the Ethereum network. And, we feel pretty compelled by the story there. Currently, Bitcoin's got about 5 times the market cap of Ethereum, but there's a theory, a hypothetical, that eventually Ethereum will eclipse Bitcoin's market cap. They call it the flippening. And I think investors need to be prepared for the flippening, because the entire DeFi or this entire this new backbone of infrastructure that's been put in place for crypto and these types of assets runs on the Ethereum network. Okay, it is the trust commodity, according to Joe Lubin, the co-founder of Ethereum, and it is expanding because it provides transparency, it provides verifiability, and it provides instant execution on all transactions. And so, this is going to disrupt the current financial services regime. And I think, being long Ethereum, which you can do via an ETF that's run by BlackRock, the iShares Ethereum ETF, and it's ETHA, trades, basically lockstep with the cryptocurrency itself, and you can hold it in a brokerage account, right? Well, it gives you a hedge against, potential disruption, right, in the current financial services regime. It gives you a non-dollar asset, and it gives you the ability to capitalize on the growth of the Ethereum network. So for all these reasons, we think Ethereum looks like an interesting play for those who want to commit, the top of the pyramid of their portfolio, the speculative portion, to an asset that looks like it might have upside that could be, meaningful.
Jeff, I feel like for so many investors, whether they realize it or not, they probably have an over-concentration in large cap growth, would be my guess, the average investor. You've laid out some really thoughtful cases as to how that could be a potential issue, and also laid out some really interesting alternatives, some that have already performed quite well in 2025 and others that appear to be emerging. The rare earth ETF is a new one for me, the REMX, I think you said. Thanks for that one. Not one I'd looked at yet, but I'll definitely do so.
In the newsletter, we published something called the Perfect Portfolio, which is our tactical asset allocation of ETFs that gives us exposure. That portfolio through yesterday's close is up 13% year to date, versus the S&P up 8 and change. So it's outperformed. It's produced some nice alpha. We've run this strategy since my Luthold days. There's when I kind of conceived of it. So
yeah. Jeff, this was awesome as always. Listen, you bring a ton of expertise and a lot of diligence behind your work, and I appreciate you taking some time to lay out the case for us. Congrats on some brilliant calls on precious metals. I remember our conversations that have proven to be very, very successful in 2025. And thanks for talking through some charts with us again today.
Always a pleasure, Dave. Thanks for having me on the show.
There you go. I hope you enjoyed that discussion with Jeff Huge. Again, his newsletter, Huge Insights, is really focused for retail investors. I hope you can check it out and follow Jeff's work. Conversations with Jeff that I've had over many years. I met him back in the day when he worked for Luthold Investments, based in Minneapolis. He actually would come and visit us at Fidelity up in Boston with guys like Doug Ramsey, who's the chief strategist there, even with Steve Luthold himself back in the day. And Jeff's continued that work, really applying Elliott Wave theory, but with other things as well. And I love what I get out of conversations with Jeff. He often will have aggressive targets in mind for the S&P, sort of following through. If this plays out as a major correction, here's what we might expect. And for me, I've always found that incredibly valuable. Whether you're bullish or bearish at any particular moment, I think it's super helpful to hear from people that have some pretty aggressive views, just to see what sort of evidence that they're using, whether or not you agree with them. I love how it stretches your thinking, right? Gets you out of your comfort zone and either opens you up to a new perspective or maybe challenges you in your own assumptions that you're making about the current market environment. Special thanks, as always, to Jeff Huge joining us from Minneapolis and sharing some charts and insights with us. That's it for today's episode of the Market Misbehavior podcast. Very keen on hearing other suggestions of who we should sit down with. Some of the great guests that we've had have come from people like you, just suggesting someone that you've heard elsewhere or whose work that you follow and whose work that you respect. We're definitely open to ideas. Wherever you're listening to the podcast, if you can leave a comment, make sure you do with a suggestion. We'll certainly gather all of those for consideration. As a reminder, if you want to learn more about some of the tools and techniques that Jeff and I would use to analyze these current market environments using technical analysis and behavioral investing techniques, our Market Misbehavior Premium memberships may be a great way for you to upgrade your own toolkit in August, September, and beyond. 3 great benefits of the premium membership. First off, you will have access to all of our virtual courses like Flight School Behavioral Investing, where we teach you all about behavioral biases and the technical analysis toolkit. You will also have access to our members-only reports like our weekly flight plan. That is our main investment report where we reflect on the week that just happened. What did we learn? What was new? What was different? We look forward at the week to come. What levels, signals, patterns are we watching for? Finally, you'll have full and immediate access to our members-only community. This is a supportive space with like-minded investors navigating these markets, asking questions about different charts and technical tools, about behavioral biases, about different insights and routines. I'm in there every day answering questions from our premium members, and I would love to answer your questions as part of that effort as well. For more information on our premium memberships, go to marketmisbehavior.com/premium. Don't forget to use the code podcast when you check out for 30% off your first 12 months on any plan. That'll do it for today. I'm Dave Keller with Market Misbehavior. Thanks so much for listening and/or watching today. And remember, it's always a good time to own good charts.